I thank the Outlook Money for inviting me to speak on pension, which is important for all of us. I propose to focus, excuse me. I propose to focus on national pension system in the context of the theme that we have today. 40 years of age is an important stage in life. One looks back while looking into the future, both professionally and financially. Prudent financial planning, particularly retirement planning, early in one's career becomes important for financial well-being. Let me talk about the dictates of demography. Why should retirement planning take center stage while approaching the age of 40? To appreciate this, it is useful to reflect on a demographic trend. The average expected life at the age of 40 is about 35 years. Going forward, it is projected to improve, and in coming years, we may touch about 40 years. So this is the stage, age 40. The person gets to reflect, where does one stand in terms of attaining his important financial goals, particularly retirement planning, that is essentially to live a dignified retired life post-superannuation. You know, India is currently the fastest growing large economy in the world. At the same time, it is also projected to age rapidly. The share of population over age 60 years is projected to increase from 10.5% in 2022 to 20.8% by 2050. This aging is likely to accentuate as every fifth Indian is expected to be over 60 years of age by the middle of the century. Further, the old age dependency ratio is expected to increase from 18% in 2020 to about 30% by 2050, exerting pressure not only on the younger generation, but also on our overall financial resources. Longevity of the present and future generation of Indians would be much higher. Living longer implies that one needs money for a longer period to take care of oneself when one is not able to work to earn for themselves. The retirement phase becomes more challenging because of the increase in medical expenses, increasing nuclear family structure, and limited access to formal credit facilities. Thus, with every passing year after superannuation, one gets exposed to financial risk unless adequate provision has been made to take care of retirement. I may underscore that women are more exposed to longevity risk as compared to men. World over, women live 2 to 3 years more than their male counterparts. In India, the expectation of life at age 60 was estimated to be around 19.2 years for women as against 17.5 years for men. Therefore, as we navigate through the complexity of our evolving socioeconomic landscape, the role of pension in securing the future of our elderly citizen is very crucial. In the past, pension was perceived to be the privilege of government employment. It is no longer so with the introduction of the national pension system in 2004, first for the government employees, and then extended to the private corporate, including the common person, and now to children with the scheme of NPS Vatshalya, which was recently launched by the government. NPS Vatshalya can be seamlessly ported to workplace pension on the child coming of age and joining workforce, thereby providing continuity to one's retirement savings account. Thus, now any member of the family from infancy to 70 years can join NPS. As the vesting period is enlarged, one could harness the power of compounding to accumulate substantial corpus, providing adequate pension in one's retirement. The concept of compounding is not easy to understand. For instance, with an annual return of, say, 8%, rupees 100 put in savings could grow 10 times in 30 years, but 101 times in 60 years. If the child from zero takes a pension and or 60 years of vesting period, see, whatever money put there would be more than 100 times by the time one takes a retirement. NPS offers a lot of flexibility. The introduction of NPS in India marked a paradigm shift in transition from a defined benefit to a defined contribution system, enhancing the stability of our pension system. The growth of NPS resulted in a notable 7.2 crore subscriber enrollment. So that's about NPS and APY combined, and assets under management growing to over 13.4 lakh crore. At present, this NPS particularly has a subscriber base of 1.54 crore. 94 lakh of that comes from the government and 60 lakh from the private sector, including the common person. NPS provides a robust platform to provide pension products for all the strata of our society. The uniqueness of NPS not only lies in its low-cost structure, but also the flexibility it offers. First, digitization played a crucial role in our NPS structure. It offers flexibility in onboarding. One can subscribe NPS through offline or online mode. For offline, one can visit any nearest branch of registered points of presence, such as banks, available across the nation, thus enabling a convenient and faster onboarding process. Under online mode, there are various options available, such as onboarding using net banking, mobile app, and e-NPS. Second, NPS offers flexibility in terms of making contribution to the scheme. One can invest any amount without any ceiling under NPS corporate model. There is flexibility for contribution either by the employer or employee or by both. The NPS account remains active only with an annual contribution, just rupees 1,000. Of course, with 1,000 you would not get much pension, but what I'm trying to underscore that you put 1,000 rupees in a year, your NPS account remains active. It is not necessary to contribute every month. Thus, NPS is suitable for people or small business with irregular income. Third, NPS offers flexibility of selecting pension fund. One can select any of the currently 11 pension funds registered with the PFRDA and can also change it once a year. If the performance of the fund manager doesn't meet your expectation, you can always change your pension fund. Fourth, NPS provides ample flexibility in terms of asset allocation. It offers auto choice and active choice as major type of asset allocation. In auto choice, one gets to select any one of the life cycle fund out of the four, namely LC 25, LC 50, LC 75. This connotes the 25, 50, 75 with the equity component in that. And recently launched, we launched on 1st of October, a balanced life cycle fund BLC. In active choice, one can make asset mix among asset classes, for example, equity, corporate bond, and government securities with appropriate proportion depending one's risk appetite. One can invest maximum up to 75% in equity in case of active choice. In BLC, the equity allocation up to 50% is maintained until the age of 45, and tapering of equity really starts thereafter instead of age 35, as in the other life cycle fund, the three, LC 25, 50, 75 that we have. Fifth, the change in asset allocation is allowed once in a quarter, which is effectively 4 times you can change your asset allocation in a financial year. This provides opportunity to an active investor to realign her portfolio with economic cycles to earn optimal return. Sixth, at the time of exit, minimum 40% of the corpus is annuitized. The balance maximum 60% could be withdrawn lump sum, both are tax-free. What you annuitize and the lump sum payment. Annuity can be purchased from any of the 15 empaneled annuity service provider, meaning insurance companies. Additionally, the option of selecting the annuity variant is also available to subscriber. We have allowed the deferment of annuity and lump sum amount on superannuation age. Subscriber can defer his or her exit and stay invested in NPS up to 75 years of age. Additionally, the subscriber can have the option to withdraw the lump sum without amount, from the systematic lump sum withdrawal in phased manner up to the age 75, or withdraw anytime the entire amount. Even the lump sum can be withdrawn in a phased manner through, the SLW as you would indicate. Somebody doesn't like annuity immediately, you can always defer your annuity to age 75. You can use the lump sum in SLW and can defer your annuity. By then the money is still accumulated there and would give you returns. NPS provides competitive returns and it is tax efficient. Beside being low cost and flexible, what makes NPS active is its competitive returns. For instance, as on September 2024, the equity scheme of NPS has given a compound annual growth rate, CAGR, of 14.5% since inception. Corporate bond, 9.1%, and the government securities, 8.9%. Similarly, the scheme for the central government employees, which is a mix of both debt and equity, has given a CAGR of 9.6% since inception. The tax advantage that NPS offers makes NPS a desirable product in one's retirement planning. Contribution to NPS is tax efficient both for the employer and employee. The Union Budget 2024-25 raised the deduction of expenditure by employees under Section 36 of the Income Tax Act towards NPS contribution from 10% to 14% of the employee's salary. Similarly, deduction of this amount up to 14% of salary from income of the employees, Section 80cc D2 of income tax is allowed under the tax regime, which means 14% is tax deductible both by the employer and employee, because for the employer it becomes a corporate expenditure, business expenditure, and the employee also can claim that deduction. But for the employee to claim that deduction of 14%, you have to be in the new tax regime. Of course, you would all know that under the old tax regime for individuals, NPS has an additional tax benefit of investment up to 50,000 under 80cc D 1B on top of 1.5 lakh under 80cc D1 deduction. That deduction is allowed from the income. We have taken a lot of regulatory initiatives. Over the period, PFRDA has undertaken several key initiatives for orderly growth of the pension sector while promoting old age income security, emphasis on simplifying the processes and strengthening security within the NPS system. This includes providing flexibility to choose among central record-keeping agencies, enabling contribution through various modes, including recently we launched the Bharat Bill Pay, so one can really make a payment very easily through that. Expanding investment universe, increasing usage of technology, and ensuring cyber security. These initiatives align with the broader objective of financial inclusion and thus striving towards old age income security of diverse demography. Other notable initiatives include the introduction of the same-day investment of contribution on T+0, choice of multiple pension scheme, mandatory penny drop verification to prevent fraud, and anti-money laundering declaration through eNPS platform. Overall, these initiatives by the PFRDA underscore the proactive approach in managing and safeguarding NPS, ensuring that it remains a robust and secure investment vehicle for the subscriber. Further, I may share that as was envisaged in the Union Budget 23-24, PFRDA has undertaken comprehensive review of all extant 11 market-facing regulation to simplify, ease, and reduce cost of compliance. So let me conclude. NPS is a low-cost, flexible pension scheme for all. Notwithstanding its user-friendly features, sustained efforts are warranted to ensure that employees in the private corporate sector, small business, professionals, women, and parents for their children to join NPS for achieving a pension saturation. It is important to mention that our current pension assets to GDP ratio is around 16.5%, while the same ratio in the developed countries like the UK, the US, and Australia is over 100% of their GDP. And if you talk of some Scandinavian countries, it's even more than 200% of the GDP. And same ratio for the OECD countries, about 82% in 2023. In comparison, NPA assets are about 4% of GDP, our GDP. This suggests that the Indian pensions industry is still evolving, and there is a long way to go. We at PFRDA are committed to protecting the interests of its subscriber and fostering trust in the pension ecosystem through continuous improvements in security, transparency, and operational efficiency. Once again, I thank the Outlook Money for inviting me to interact with you. Thank you.